fundsupermart.com.
Hi. Over the course of 2013, European equities quietly and steadily inched upwards, finally ending the year as one of the best performing markets. How did this happen?
Well, I think for a lot of people in Asia, it comes as some surprise just how well European markets actually performed in 2013. But you're not alone, because it certainly surprised us too. So we need to look at what's been good. So if we sort of break that down from the sort of macro point of view and look at some of the things that have improved over the course of the year. Late in 2012, or midway through 2012, we had the ECB deciding to act as a true lender of last resort, and that has continued to calm the markets through the course of 2013. We've had some of the periphery countries, like Greece, like Spain, actually make some decent progress over the course of the year. Who would have thought it, but Greece is actually set to return to growth in 2014. Spain, after having put through some quite tough structural reforms, has beaten consensus expectations just about more than any other major area in the Eurozone. So that's all been good. From a growth perspective, Europe is actually set to grow in 2014, but that growth really needs to be put into context. The IMF predicts that Eurozone GDP growth will be about 1.5%, so still pretty low, and compared to other parts of the world, absolutely quite low. From a stock market perspective, so sort of pulling it back to what's actually happening in terms of the stock market, what we've seen is a lot of the share price performance has been driven by what people term re-ratings. So rather than the underlying earnings picture having improved, investors are actually just prepared to pay more for the same thing. And it's estimated that this re-rating effect has probably driven as much as 3/4 of the increase in share prices over the period. So we think for markets to move higher again, we really need to go back to the fundamentals, and the earnings part, the E part of the PE, really needs to start doing some of the work.
With the European economy finally expanding once again, how will the stock market react, assuming that this is positive news to the corporate earnings?
So we've talked about the re-rating effect in the European stock market, and the fact that this has actually driven a lot of the share price performance. If you look at earnings momentum over the course of the year, it's actually been negative. So what we need to happen is a return to the fundamentals. We need to see global growth start to improve, and for that growth to be self-sustaining. And by that we mean not reliant on just more liquidity in the system, just more unconventional monetary policy support. So we think if we can see a return to a modicum of earnings growth, that could drive markets higher. But we're quite cautious on how much earnings growth we expect to see over the course of the next year.
Is the debt crisis in Europe finally behind us, or will it continue to haunt investors every now and then?
I don't think so. I certainly don't think the debt crisis is behind us. Debt is still a big issue for Europe. Debt levels in the periphery especially are still high, and they continue to rise in a lot of cases. The problem for politicians and from a sort of fiscal point of view, the policy decisions that politicians have to take are fraught with difficulty. Austerity is necessary, but austerity brings with it a lot of social instability. We see record unemployment levels in Italy and Spain. Raising taxes is another option, but that can stifle economic growth in a nascent economic recovery. And one of the more sort of worrying things is that as things start to improve, the political imperative and the political will to actually continue taking the hard measures and continue pushing through the structural reform lessens. So that would worry us. We talk a lot about Fed tapering and what effect that might have on emerging markets. We don't really want to get too fixated on any one big macroeconomic event, but were higher interest rates to start to feed through into Europe, we think some of those countries in the periphery with highly leveraged balance sheets, with a lot of debt, might actually not be best placed for a gradual rise in interest rates. And lastly, if you look at the banking situation in Europe, we think to a large extent that is actually restraining the pace of the recovery. Yes, we've seen yields on government debt come down in places like Spain and Italy, but we haven't seen the interest rates in the banks and the interest rates charged by those banks to their customers actually come down. So those very necessary capital flows to the small and medium-sized businesses that really need to drive the recovery aren't really happening, and that would be a concern.
The European region is a large one. Does it provide equal opportunities all around, or are there specific areas, whether geographical or sectorial, that investors should pay more attention to?
So, for those of us who know, for those of you who know Aberdeen quite well, you'll know that we think of Europe as merely a domicile for companies. So the way we look at it is not, we prefer Germany or we prefer Sweden, or, we think this particular macroeconomic event is going to be good for this country or this particular sector. That's not our starting point. Our starting point is always to try and identify the best quality businesses within the region as a whole. And quite frankly, we don't mind where they come from. So for that matter, when we go and do our work on the ground, just to give you a bit of a flavor, we see good opportunities throughout the whole of Europe. We find that when we go to Germany and Switzerland, for instance, there's really, really good small and mid-cap industrial companies trading at quite attractive valuations that probably, are not necessarily on every investor's radar. So we see good opportunities there. When we go to the Scandinavian countries, we like the management teams. We like the focus on strong balance sheets and prudent use of capital. So we find good opportunities in Scandinavia too. And in the UK, and thinking about the UK as part of Pan-Europe, we like the strength of company management teams in the UK. We like the corporate governance framework that they operate within. So it's a good blend and it's a good mix and richness of companies and businesses in Europe. But there's never one particular country that we focused on, because we always start from the point of view of being bottom-up stock pickers.